Hello, this is Dave Alison, founder and CEO of Alison Wealth Management, and I want to welcome you to our second quarter 2024 Market Intel Report. In this report, we're going to be focusing on the key themes that are on the minds of investors today. Now, coming off of the first quarter, we saw strong stock market returns. The first quarter has been kind of referred to as this Goldilocks stock market, where it's not too hot, not too cold. I think a lot of optimism that the Fed was going to be cutting interest rates. The market had originally priced in 3 potential interest rate cuts, with the first one starting in May or June. But as we've seen, inflation has been a little bit more persistent than the Federal Reserve would have hoped. And so that's created some of this more recent volatility in the stock market as of late. So in this video, we're going to be talking about the progress on fighting inflation. And is that progress beginning to stall? We're also going to talk about the potential implications of the Federal Reserve's next move on the US economy. And then last but not least, we're going to round out this market intel report by talking a little bit about the stock market, what stocks are driving the majority of the returns in the market today. We're going to be diving deeper into the Magnificent Seven and talking about whether we believe market participation could broaden, meaning the other 493 stocks in the S&P 500, for example, start to perform, and it's not predominantly reliant on the returns of those Magnificent Seven stocks. And so let's jump right into our first key theme. Is the progress on inflation stalling? Now, what you can see in this chart is, as of the end of March, headline CPI, which is the Consumer Price Index, was hovering around 3.2%. As you can see in the illustration here, it is substantially come down from those highs that we saw in 2022, but it still is not where the Federal Reserve would like it to be. At least it's not where they would like it to be in order to start creating stimulus by cutting interest rates. Now, when we break down that headline CPI, it's really comprised of 2 major components. We've talked about the shelter component of CPI, right? Rents and housing cost. And as you can see in this chart, that shelter CPI is still quite high. It's still sitting around 5.8%. Now, we know that shelter CPI tends to be sticky, right? It's not every day or every month that landlords are adjusting the cost of their rent. And we believe a lot of this falling shelter cost still is not reflected in the CPI data just yet. You can see a lot of this started to peak again in 2022, and it's been falling rapidly. But if you watched the news over the last couple weeks, you've seen that the April inflation data came out a little bit hotter than expected, and that's spooked the markets a little bit. We saw a lot of volatility a couple weeks in a row that the market has been down after a really strong first quarter in the stock market. And a lot of that is that the market is now saying, well, instead of the Fed maybe cutting interest rates 3 times, it could only be 2 times. Interest rates might stay higher for longer. And there's even some chatter going on about the Federal Reserve having to potentially increase rates again to try to cool this economy and the inflation. And so that's something that all market participants will be keeping a keen eye on. Now, let's talk about some of the implications of the Federal Reserve's decision and the impact on the economy. And as we've mentioned before, they have a very challenging balancing act here. A lot of people are calling the economy right now this Goldilocks economy. You know, it's not too hot, it's not too cold. We're balancing this state of steady economic growth and moderate inflation. The jobs market is remaining quite strong. And if the Federal Reserve holds interest rates high for too long, they can start to have some cracks in the economy. It could emerge as a lagged effect, and we could see things like slowing growth in the labor market. We could see inflation fall due to a weakening consumer demand and how people are going out and spending money. That could equate to companies not earning as much earnings, which could reduce their stock price and create more volatility. Or even worse, it could force the Fed to cut interest rates in an attempt to stimulate a weak economy and potentially avoid a recession. So, again, some of the risks of the Fed holding rates too high for too long is it could potentially put us into a recession. Now, on the flip side of that, if the Federal Reserve cuts rates too prematurely, it could mean that inflation is going to continue to run rampant and remain high. It could reaccelerate inflation due to a reacceleration of demand. Think about it. If interest rates get cut, more people might go out and borrow money to do renovation projects on their home, buy a bigger house, go invest in their business. And so, again, if the Fed cut rates prematurely, it could produce strong economic growth. It could reaccelerate inflation. And the Fed may need to reserve their entire course and then go back to raising interest rates again. And that could, of course, put us in recession risk. And so, again, it's a bit of a tightrope walk that the Federal Reserve is doing and ultimately has a lot of impact on how the economy will grow. And again, the focus and the mandate of the Federal Reserve is to try to get inflation to that core 2% target, to keep job sustainability, and to ultimately not put us into a recession. And it certainly is a little bit of threading the needle to get us there. The last thing that I want to talk about in today's Q2 market intel report is, could overall stock market participation broaden beyond the Magnificent Seven? If you've turned on the news, you've probably heard of the Magnificent Seven. These are 7 technology stocks comprised of Apple, Microsoft, NVIDIA, Google, Amazon, Meta, and Tesla. And these stocks have performed incredibly well in 2023 and so far in 2024. Now, part of the reason they've performed well is they lost a whole bunch of value in 2022. And so in 2023, these companies did a really good job at cleaning up their operating expense and starting to return to a solid level of profitability that Wall Street rewarded, as well as the artificial intelligence craze that's been going on, leading companies like NVIDIA and Google and Microsoft and Meta much higher. Now, what we've started to see is that things haven't been all that magnificent for everybody in the Magnificent Seven this year so far. For example, Apple and Tesla have underperformed the market. They've started to take a step backwards. And what we're starting to see are really 4 things with these stocks. Number one is they all have very elevated valuations, which is causing investors to go look for other opportunities outside of the Mag 7. Some people are hesitant to start buying into these stocks at the current price point that they're at, particularly with all the growth they experienced in 23 and 24 so far. Number 2 is that if the Federal Reserve does start to cut interest rates, that could be a boon for smaller and mid-cap companies that rely heavily on financing for their growth. Many of those small and mid-cap companies are not going to the bank and taking loans out because of the high interest rates. If we see those interest rates come down, those companies might take out some leverage to invest in more growth opportunities, which could be a positive for small and mid-sized company growth in the stock market. Number 3 is the productivity benefits of artificial intelligence are likely to broaden out. I think companies like Meta and Microsoft and certainly NVIDIA are seeing a lot of benefits of artificial intelligence. But as the technology develops, more and more companies are going to start to implement it, which means hopefully they will achieve productivity benefits, which could boost their stock price. And last but not least, over the long term, artificial intelligence could meaningfully boost the labor productivity market, accelerating the potential growth rate of the US economy, and just therefore broaden earnings growth amongst more companies, not have so much concentration in these 7 technology companies that have received the lion's share of the benefit. And when I say lion's share of the benefit, if you look at 2023, the Magnificent Seven accounted for over 74% of the S&P 500's growth. So just in closing here, these are the 3 key themes on the minds of investors as we go into the second quarter. We had a great first quarter coming off of a great year in 2023. There's still a lot of momentum in the economy, a strong labor market, and the big driver right now is keeping our eye on inflation and what the data continues to produce so that we can start to understand what the Federal Reserve's actions are going to be, whether it's keeping rates higher for longer, whether it's a potential rate increase in our future to continue to try to fight inflation, or whether we continue to make progress getting towards that long-term Federal Reserve target of 2% inflation, and maybe rate cuts are in our future. If there is anything you need or any questions you have, please reach out to our team or your advisor. We're here to help, and I'll see you in the next quarter.